Ever wonder about the first step to building a strong financial portfolio? It's defining your financial goals. Imagine setting out on a journey without a destination. Sounds challenging, right? The same principle applies to building a financial portfolio. Without clear goals, your investment journey might be rudderless and unproductive. So the first step is to define your financial goals. But what does that mean? Simply put, a financial goal is a monetary target you aim to achieve within a specific time frame. These goals are pivotal as they form the foundation of your investment strategy. Now, these goals can be as diverse as the people setting them. For some, it might be saving for a comfortable retirement, ensuring they can maintain their lifestyle even when they're no longer working. For others, it might be accumulating a down payment for a house, turning the dream of home ownership into reality. Maybe you're thinking about your child's future and you want to build a college fund. Or perhaps you aspire to launch your own business someday and you're saving to make that dream come true. All these are examples of financial goals that could drive your investment decisions. But remember, these goals aren't set in stone. As your life evolves, your goals might change too. Bought that dream house already? Now, you might want to focus on retirement. Paid off your student loans? Perhaps it's time to think about an investment property. The key is to regularly revisit and revise your goals as your personal circumstances change. And there's one more thing. When setting financial goals, be realistic. It's great to aim high, but your goals should also be achievable. Break down larger goals into smaller, manageable milestones. This way, you'll stay motivated and focused, making the journey towards financial success a rewarding one. Remember, your goals shape your investment strategy, so define them clearly. Your financial goals are the compass guiding you towards your investment destination. So spend some time defining them. It's the first step towards building a strong financial portfolio. Now that you've defined your goals, it's time to assess your risk tolerance. Risk tolerance in the world of finance refers to the degree of variability in investment returns that you as an investor can withstand. In simpler terms, it's about how much loss you can endure before you start to panic. Understanding your risk tolerance is akin to knowing your financial personality. It's about recognizing your comfort zone when it comes to handling potential losses in your investment portfolio. Some folks might be thrill seekers, willing to take on high-risk investments for the chance of high returns. Others might prefer the slow and steady pace of more secure investments. There's no right or wrong approach here, just what suits you best. Age and financial situation can significantly influence your risk tolerance. Generally, the younger you are, the more risk you can afford to take. Why, you ask? Well, it's because you have more time to recover from any financial setbacks. On the other hand, if you're nearing retirement, you might want to play it safe and opt for lower risk investments. Your financial situation also plays a crucial role. If you have a stable income and a good amount of savings, you might be more comfortable taking on risk. But if you're living paycheck to paycheck, every investment decision becomes a lot more critical. Risk tolerance also impacts the choice of your investments. If you're comfortable with risk, you might lean towards investments like stocks or real estate, which can offer high returns but come with a degree of volatility. If you're more risk-averse, you might opt for bonds or money market accounts, which offer more stable returns. Remember, understanding your risk tolerance isn't a one-and-done deal. It can change over time as your life situation changes. Regularly reassessing your risk tolerance is an integral part of managing your financial portfolio. Understanding your risk tolerance helps you choose investments that align with your comfort level. It's the bedrock upon which you can build a robust and resilient financial portfolio. So take the time to get to know your financial personality. It'll pay dividends in the long run. Scene script. Ever heard the phrase, "Don't put all your eggs in one basket"? That's exactly what diversification is all about. Now let's delve into the principle of diversification, a cornerstone of a well-rounded financial portfolio. Essentially, diversification is the practice of spreading your investments across various asset classes, such as stocks, bonds, and real estate. Why is this important, you ask? Well, imagine if you had invested all your money in a single company's stock, and that company goes bankrupt. You'd lose your entire investment. But let's imagine a different scenario. Let's say you've spread your investments among 20 different companies across various sectors. If one company goes belly up, the impact on your overall portfolio will be significantly less. That's the power of diversification. It helps to mitigate risk and at the same time can enhance your potential for returns. Now, diversification isn't just about investing in different companies, it's also about investing in different types of assets. Each asset class behaves differently under different market conditions. For instance, when the stock market is on a roll, bonds may not perform as well. Conversely, when the stock market is down, bonds often hold steady or even gain in value. By investing in both stocks and bonds, you can balance out the highs and lows, smoothing out your investment returns over time. Real estate is another asset class to consider for diversification. Just like stocks and bonds, real estate has its own unique set of dynamics. It can provide a steady income stream through rental returns and potential capital appreciation over the long term. One more thing to remember is that diversification isn't a one-size-fits-all strategy. The right mix of assets will depend on your financial goals, risk tolerance, and investment horizon. It's always a good idea to seek advice from a financial advisor to tailor a diversification strategy that suits your individual circumstances. Diversification is your safeguard against market volatility, so spread your investments wisely. Diversification is important, but so is the quality of your investments. Just like a well-balanced meal, a healthy financial portfolio is a blend of different investment types, combined in a way that suits your financial goals and risk tolerance. But it's not enough to simply spread your investments around. You need to ensure that the investments you're choosing are of high quality. So how do we define a quality investment? Well, at a basic level, a quality investment is one that has a strong track record and offers good growth potential. This doesn't necessarily mean it's the hottest stock on the market right now, but rather it's an asset that has consistently performed well over time and is expected to continue doing so. Think of it this way, if you were to bet on a marathon runner, would you choose the sprinter who starts strong but tires quickly, or the steady, consistent runner who maintains a solid pace throughout the race? The same principle applies to investing. Steady, consistent growth is usually a safer bet than a quick burst of success that may not be sustainable. So when you're selecting investments, you might want to consider blue-chip stocks, which are shares in large, well-established companies with a history of reliable performance. They may not offer the thrill of a high-risk, high-reward investment, but they're generally a safer bet for steady growth. Diversified mutual funds can also be a good choice, as they spread their investments across a wide range of assets, helping to mitigate risk. Similarly, bonds from reputable issuers can offer a steady stream of income with less risk than stocks. But remember, even the best investment can lose value sometimes. That's why it's important to regularly review your portfolio and adjust your investments as needed to ensure they're still aligned with your financial goals and risk tolerance. In conclusion, when building your investment portfolio, don't just focus on quantity. Quality is equally, if not more, important. Carefully select assets with a strong track record and good growth potential to help ensure the long-term success of your portfolio. Focus on quality over quantity to ensure your portfolio's growth and stability. As markets change, your portfolio should too. That's where rebalancing comes in. It's like tuning up your car. You wouldn't drive thousands of miles without checking the oil, would you? Similarly, you need to periodically review and adjust your financial portfolio. Let's start with understanding what rebalancing is. It's the process of realigning the weightings of your portfolio of assets. Rebalancing involves periodically buying or selling assets in your portfolio to maintain an original or desired level of asset allocation. For instance, if stocks have performed well recently and bonds have underperformed, your portfolio may be heavily weighted towards stocks. Rebalancing would involve selling some stocks and buying bonds to get back to your desired allocation. Now, why is rebalancing necessary? Well, the market is not static. It's constantly changing, influenced by a myriad of factors from economic indicators to geopolitical events. When these changes occur, they can cause your asset allocation to drift away from your original target. If left unchecked, this drift could expose your portfolio to a level of risk that's beyond your comfort zone. How often should you rebalance? There's no one-size-fits-all answer. Some financial experts suggest doing it on a regular schedule, like annually or semi-annually. Others recommend rebalancing only when the allocation of your assets drifts by a certain percentage. It all depends on your personal circumstances, financial goals, and risk tolerance. Keep in mind, rebalancing isn't just about risk. It can also be about opportunity. If an asset class or specific investment is doing well, you might want to take profits and reinvest them elsewhere. Or, if the market has taken a downturn, rebalancing might provide a chance to buy assets at a lower price. Remember, rebalancing isn't about chasing performance, but about sticking to your financial plan. It's a disciplined, systematic approach to ensure that your portfolio continues to reflect your investment goals and risk tolerance. Regular rebalancing ensures that your portfolio stays aligned with your goals and risk tolerance. It's a simple yet powerful tool in your investment toolkit, so get in the driver's seat, keep an eye on the road, and make those necessary adjustments to keep your financial journey on track. Investments come with costs. It's crucial to keep an eye on these fees. And that's the truth of it. No matter where or how you invest, there will always be fees to consider. They may seem insignificant at first, but over time, they can make a substantial dent in your returns. Let's start with transaction fees. These are the costs you incur every time you buy or sell an investment. Whether you're trading stocks, bonds, or other securities, each transaction usually comes with a fee. Some brokerages offer commission-free trades, but it's important to read the fine print. There might be other costs hiding in the shadows. Next up are management fees. If you're invested in mutual funds or exchange-traded funds, ETFs, you're likely paying a management fee. This is a percentage of your invested assets that goes to the fund manager for their expertise and services. While it may seem small, even a 1% management fee can add up over the years, especially as your investments grow. Then there are expense ratios. This is a measure of what it costs an investment company to operate a mutual fund, or ETF. An expense ratio includes management fees, administrative fees, and other operational costs. Just like management fees, these may seem minimal, but can accumulate significantly over time. Lastly, let's talk about load fees. These are charges that fund companies impose whenever you buy or sell shares of certain mutual funds. Front-end load fees are paid when you buy into a fund, while back-end load fees are paid when you sell your shares. So how can you keep these fees from eating into your returns? The key is mindfulness and research. Look for investments with low fees, like index funds or ETFs. These typically have lower expense ratios than actively managed funds. Also consider working with a brokerage that offers commission-free trades. But remember, it's not just about finding the lowest fees. The quality of your investments matters just as much. Being mindful of fees can help maximize your investment returns. And that's the bottom line. So keep your eyes peeled and your calculator handy as you navigate the world of investing. Before you dive into investing, make sure you have a safety net, an emergency fund, and insurance. Imagine you're walking a tightrope. 100 feet below is a rocky canyon, and you're inching your way across step by step. Now, wouldn't you feel safer with a net beneath you? Of course you would. That's exactly what an emergency fund and insurance coverage are to your financial journey, a safety net. An emergency fund is a stash of money set aside to cover the financial surprises that life throws your way. These unexpected events can range from losing your job, unexpected medical bills, to sudden home repairs. Without an emergency fund, these unexpected expenses can force you to dip into your investments, potentially derailing your long-term financial plans. So, how much should you have in your emergency fund? Typically, it's wise to have 3 to 6 months' worth of living expenses. However, this can vary depending on your individual circumstances. If you have a stable income and strong support system, you might feel comfortable with 3 months' worth. But if your income fluctuates or you're the sole breadwinner, you might opt for a larger cushion. Next, let's talk about insurance. Just like an emergency fund, insurance provides a layer of financial protection against unforeseen events. From health insurance to protect against medical costs, to home and auto insurance, safeguarding your valuable assets, to life insurance, ensuring your loved ones are cared for, insurance can prevent a financial catastrophe. The type and amount of insurance you need will depend on your personal circumstances. For example, if you have children, a life insurance policy is a must. If you own a home, homeowners insurance is essential. Research, understand, and choose policies that best fit your needs and budget. In summary, before you dive deep into the world of investing, ensure you have a solid safety net in place. An emergency fund and insurance coverage can help cushion the blow of life's unexpected expenses and prevent you from prematurely liquidating your investments. An emergency fund and insurance are your financial safety nets. Make sure they're in place before investing heavily. And there you have it, a step-by-step guide on building a strong financial portfolio. We've walked through defining your financial goals, understanding your risk tolerance, diversifying your investments, and choosing quality assets. We've also highlighted the importance of regular portfolio rebalancing, keeping an eye on fees and ensuring you have an emergency fund and adequate insurance. Remember, building a robust financial portfolio doesn't happen overnight. It's a continuous process that requires patience, diligence, and a keen eye for opportunities. As you navigate the world of personal finance, don't be afraid to ask questions, seek advice, and continuously learn. Above all, patience is your best friend in investing. The most successful investors are those who stay the course, undeterred by short-term market fluctuations, keeping their eyes firmly fixed on their long-term goals. Remember to like, share, and comment below with your own portfolio building tips. Until next time, stay financially savvy.